Right now, billions of dollars worth of AI hardware are sitting in state-of-the-art data centers that cannot be turned on. And while most investors are still obsessing over Nvidia's lead times, they are missing a physical wall that money alone cannot break. It's not a chip shortage anymore. It's a power crisis and a market where demand is guaranteed, but delivery is limited. And in markets like that, the winners aren't the buyers. They are the ones who own the bottleneck. The question is, who are they? So today, we'll first have a look at this once-in-a-generation megatrend, and then I'm showing you 6 companies that own the keys to the AI revolution. And if you're new here, my name is Florian and I'm a physics engineer from Germany with a passion for data-driven and objective investing. Welcome to the channel and thank you for joining me today. So, most retail investors are still focusing on GPU lead times and chip shortage for AI, with many calling this a capacity crisis and a structural shift. But those are digital problems, and there is a much harder physical limit hitting the sector that money alone cannot solve. It's called the power wall. Because hyperscalers like Microsoft or Google can build data centers in 18 to 24 months. But the transformers and grid upgrades that actually connect the data center to the grid are missing. And this leaves some completed data centers just sitting there, without the possibility to even be turned on. We are even looking at lead times of several years here. So we have a multi-year mismatch where billions of already invested dollars in compute could literally sit idle and not being used. But this isn't just about AI. We are witnessing several huge structural trends right now. Yes, we have the data center demand that is expected to grow at 10 to 18% annually through to 2030 in the US, according to this study of the International Energy Agency. But at the same time, we are electrifying everything from cars to home heating, while simultaneously reshoring heavy manufacturing and industry back to the West. This study from S&P Global shows that between all of these trends, the global electricity demand shall rise by 47% until 2040. This is significantly quicker than all other forms of energy. But here's the thing. Our current energy grid was never even designed for this. In Europe, 40% of the grid assets are over 40 years old. And in the US, the situation is similar. So a significant amount of investments will be necessary to make them ready for this. And we are not only talking about power generation, but also the transmission and distribution. The equipment that moves that power. And for fundamental investors, this bottleneck provides a real moat. Because the companies that own the production capacity for the cables and transformers aren't just selling a product. They are essentially selling the ability to participate in these important economic trends. Now, if you want to understand the real potential here, you only have to look at the capex budget of the hyperscalers. Goldman Sachs just recently revised their estimates and are now projecting that the major global hyperscalers will double their capex and R&D spending by 2029 compared to 2025. Of course, not all of this is just for electricity. But it is still massive capex that is distributed to just a few players. And this creates 2 problems. First, we have of course the volume. The IEA projects that only the data center electricity consumption will reach about 950 terawatt hours by 2030, which is a doubling compared to 2024. So we have an increase of 100% in just 6 years. But the more subtle, the more dangerous problem is the spiky demand. Because traditional industrial loads are predictable, but AI isn't. When a massive GPU cluster starts an interference or training run, it's like a stadium turning on every light and appliance at the exact same microsecond. And this creates massive voltage fluctuations that can literally melt components on an unprepared grid. And for decades, we've focused our investments on the power generation itself. But we've neglected the transmission and distribution. S&P Global highlights the massive spending gap where transmission and distribution investments have lagged behind the power generation for years. This is also why the equipment for this is currently a goldmine. Grand View Research projects this market to cross 430 billion by 2030. The annual growth rates with 4% between 2025 and 2030 look a bit underwhelming at first glance. But This is a supply-constrained market where buyers are desperate and sellers have the leverage. Now, as objective and fundamental investors, we have to understand where the profit is to find the right investment. Because the first instinct might be to buy the companies that sell the electricity, the utilities. It's only logical, right? But oftentimes, this is not the best strategy. Here is the problem. Utilities are rate of return businesses. They don't get to hike prices just because demand is surging. In most jurisdictions, the profits are capped by regulators who want to keep the power affordable for the average voter. So if a utility wants to earn more, they have to spend more in infrastructure first and then beg a commission for a 2% or 3% rate hike. Here you can see the example from NextEra Energy's SEC filing. That's a pretty slow and bureaucratic way to grow. And they also face massive pushbacks. Because when AI demand starts driving up local grid costs, those costs eventually land on the bills of local residents. That creates political friction that caps the utilities' upside. Now, contrast that with the companies making the hardware, like SPX Technologies here. If there's a 4-year waiting list for a transformer, the manufacturer doesn't have to ask a regulator for permission to raise the prices. They have pricing power, so their margins expand while the utilities' margins stay flat. The typical utility trades at an average 22 times earning because their growth is predictable and capped. The equipment makers trade at a premium because the current bottleneck is owned by the people who build the grid, not the people who operate it. And when we talk about the grid, most people picture the giant steel towers with cables. But the real high-margin bottleneck is underground and sometimes even underwater. We are talking about the high-voltage subsea and underground cables. And while most US investors look at Hubbell or Eaton, the most dominant players in the cable space are European, specifically Prysmian and Nexans. They aren't just selling copper wire, they are selling high-end systems that move gigawatts of power over hundreds of miles with minimal losses. Let's look at Prysmian first. They just closed their best year ever in 2025. They have successfully pivoted from a regional cable maker to a global infrastructure giant with double-digit growth rates. Their backlog is currently sitting at a staggering 17 billion, with their transmission segment margins hitting over 20%. The big move for Prysmian was their nearly 4 billion acquisition of Encore Wire in 2024. This gave them massive high-margin manufacturing hub in the US and direct access to the North American data center market. In their 2025 results, they specifically credited data center expansion for the driving profitability in the electrification segment. Then you have Nexans. They have spent the last 3 years selling their non-core business to become what they call an electrification pure player. And it's working. Their 2025 sales hit almost 6.1 billion with a year-over-year growth of 8.3%. Their transmission segment is even up by nearly 30% year-over-year. And similar to Prysmian, they also have a massive backlog. Their transmission backlog is 7.9 billion, giving them revenue visibility all the way through 2028. And to handle this, they are launching a new state-of-the-art cable-laying vessel, the Nexans Electra, in mid-2026. So the moat for these companies is technical and physical. There are only a handful of companies that can manufacture these cables and even fewer that own the specialized chips required to install the cables under the sea. And as offshore wind and cross-border interconnectors become more and more important, Prysmian and Nexans are effectively the builders for the high-voltage underwater highway. Now, the US companies that I mentioned earlier still have a massive direct leverage over this bottleneck because they own the production for some of the most critical grid components. And Eaton is the heavyweight here. In their 2025 results, they reported that data center sales were up 40% year over year. For a company with a market cap of over 160 billion, that's an incredible acceleration. But again, the number that really matters for fundamental investors is the backlog. In their Electrical Americas segment, the backlog grew 30% last year alone to almost 20 billion. What makes Eaton especially interesting is their planned acquisition of Boyd Thermal. This should close by mid-2026 and gives them a massive footprint in liquid cooling. This is the pivot from a grid supplier to an AI infrastructure partner. Next, we have Hubbell. And if Eaton is the diversified giant, Hubbell is the pure play on the hardware that connects everything. They recently launched a grid interconnection division specifically to capitalize on the data center surge. They also doubled down on high voltage substations with their acquisition of DMC Power. And the results are already showing up in the numbers. In the fourth quarter of 2025, the electrical solutions segment saw data center sales jump 60% and overall growth in their operating profit of 18% year over year. So both of them are currently trying to position themselves for a long-term structural shift with these acquisitions. And they also have the pricing power, because in this market, the manufacturer currently holds all the cards. If you want a transformer, you pay the price and wait your turn. But you can have all the transformers, fittings and cables in the world, but they don't install themselves. And that brings us to the builders and the network owners. The most famous here is probably Quanta Services. They are the primary way to play the physical build-out in North America. They have roughly 81% revenue exposure to electric infrastructure, but their real moat is labor. Because there is a massive global shortage of skilled, high-voltage electrical workers. And Quanta has the largest labor force in the industry, and they've built their own training facilities to keep it that way. They ended 2025 with over 44 billion in backlog. What makes this even more interesting is that they usually work with long-term contracts with their customers. The risk with these contracts is wage inflation. But so far, their scale has allowed them to pass those costs through. Now, if you've been following the channel for a while, you might know that I really like the toll booth business model. And if you're looking for a toll booth kind of company with a focus on Germany and Europe, just look at E.ON. Because despite being a utility, they are unique because they've largely exited the power generation business. They are a distribution system operator that makes money by owning the wires and gas pipelines. This part makes up more than 3/4 of their overall revenue, while the sale of energy only makes up 16%. But as I showed you before, in Europe, 40% of the grid is over 40 years old. That is also why E.ON is currently heavily investing in modernizing this network. And because they are a regulated monopoly on the distribution side, their growth is also extremely predictable. As more heat pumps and data centers plug into their network, E.ON expands their rate base, the asset value they are legally allowed to earn a return on. Until 2030, they show a growth in their regulated assets of 9% annually, which will more or less directly translate into a similar revenue growth. Now, this looks all very promising, but if you look at the valuations in the sector, you might be in for a shock. This graph up here shows the forward-looking PE ratios for our 6 companies. And while all of them have been going up recently, we see the largest difference between the 10-year average and the current valuation for Quanta Services in purple. Eaton in green and Hubbell in red are also a fair bit above the averages, while E.ON and Nexans are still somewhat close to the historical values. But the PE ratio alone is a deceptive metric when we deal with a supply-constrained structural shift. Another key metric here is the backlog to revenue ratio. Because when a company like Quanta has 44 billion in backlog against 30 billion in revenue, you aren't betting on hope. You are essentially buying a contracted revenue stream. And Quanta has the highest ratio here with over 1.5 times backlog versus revenue. And I use the 2025 revenues here, by the way. Nexan comes in second here with also over a year in backlog, while Prysmian and Eaton fall slightly back. Hubbell has currently the lowest revenue to backlog ratio of only 0.37 times. Now, before I sum this up and come to the final takeaway, if you find this kind of research-heavy analysis useful and think that it helps your own investing, please subscribe to the channel to not miss my next one. I'm doing this kind of videos once or twice a week, including some deep dives on specific companies. So, thank you very much. Now, overall, I think that the bull case for these infrastructure players is actually even simpler than the bull case for AI itself. We don't know which LLM or which hyperscaler will win. We don't even know which chip architecture will be the standard in 5 years. But between electrification and AI, we do know that we will need the grid infrastructure to support it. The bottleneck isn't the software. It's the physics of moving the electrons. And I believe that we are entering a decade where power capacity is the ultimate scarcity. But there are different ways to invest in this trend depending on your preferences. If you want high growth and are not bothered by high valuations, Hubble and Eaton are the lords of the physical grid components. If you want to have a more reasonable entry point with good backlog visibility, you take the European cable manufacturers Nexans and Prysmian. With Quanta, we also have a builder with a strong moat and huge backlog, although the valuation here seems to be a bit stretched already. So on the other end of the spectrum, we also have a network operator with E.ON that is also not cheap anymore, but still far from the valuation increase of some of the others. The biggest risk that I see at the moment is not that the demand is fake. The backlog proves this. It's that the market overestimates how fast some of these companies can scale the business. But as long as the lead time for these infrastructure components is longer than the lead time for data centers, these manufacturers will hold the leverage. But as always, that's just my opinion. Now, do you agree with my list, or do you have any companies that should absolutely be part of it? Let me know down in the comments. And if you're now interested in 9 companies that are currently on their way to become the next dividend aristocrats in 2035, watch this video next. And of course, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.